Hill Guy here. Quick favor before we dive in. Tap like and hit subscribe so you don't miss the next update. Because stories like this don't show up in neat chapters. They move quietly, and then they move all at once. Sunday afternoon, January 18th, 2026. While most people were watching games, running errands, or scrolling on autopilot, a central bank page in Russia refreshed a single field at 4:37 p.m. Moscow time, no headline, no fanfare, just data. Most investors will never visit that page, and even fewer will download the tables behind it, compare dates, and notice what changed. And that's exactly why this kind of story matters. The market often reacts to narratives, not to source documents. When the narrative catches up to the documents, the move is already half done. One number sat there like a hidden alarm. $326.5 billion, the published value of Russia's gold reserves as of Jan 4th, 2026. 12 months earlier, the same line read, about $195.7 billion. That's roughly a $130.8 billion jump in 1 year. If you're thinking that can't be right, remember, it's a valuation line, not a shipping manifest. A valuation line can jump even if the vault stays still. On its face, that looks like an act of strategy. But the truth starts with something boring: how reserves are valued. Central banks don't just count bars. They report tonnage, and they also report market value, typically updated with current prices. When the price moves sharply, the valuation moves sharply. The bar didn't change, the measuring stick did. Now here's where it gets uncomfortable. The reflex is to assume Russia must have been buying huge amounts of gold. But in the same period, reported physical holdings were slightly lower, down about 6.2 tons. Less metal, more value. Put that tonnage change in perspective. 6.2 tons against roughly 2,300 plus tons is a fraction of a percent. So the physical picture barely moved, while the price picture did the heavy lifting. So what happened? In this narrative, gold repriced hard, from the mid-2000s per ounce to the mid-4000s in roughly a year. That repricing is the whole trick. Hold a lot of metal, and the valuation rises whether or not you add more. Think about sensitivity for a second. When you're holding more than 2,300 tons, even a modest move per ounce becomes a giant move on paper. And that's why this story matters beyond a chart. A bond is a promise issued by someone else, settled inside someone else's system. A bar of gold held domestically is different. You can freeze accounts, block rails, stall transfers. Metal in your vault is physical. That custody difference is the pivot. It's not about getting rich. It's about owning at least one reserve asset that can't be paused by outsiders. In a world of sanctions and counter-sanctions, counterparty risk becomes the hidden tax on reserves. Gold is one of the few reserve assets that doesn't come with a built-in counterparty. Once you see it that way, the Russia headline becomes a signal for a much bigger shift. Trust management in a sanctions world. To understand the logic, zoom out. In the late 1990s, Russia wasn't a gold heavyweight, and its reserve mix looked very Western. The doctrine was simple. Hold interest-bearing paper, treat gold as deadweight. For a while, Russia played that game. Also remember the emotional context. Nations don't build reserve policy for good times. They build it for the day relationships break, markets freeze, and nobody answers the phone. Then came shocks that changed incentives. Early 2000s geopolitics reminded policymakers that custody and jurisdiction matter. And the 2008 financial crisis proved how fast major central banks can expand balance sheets when stability is threatened. That raises a brutal question for any non-issuer nation. If the reserve issuer can create unlimited units in a crisis, what exactly are you holding when you hold that paper? A claim on value? Or a claim on policy choices you don't control? Starting around 2009, Russia leaned into steady accumulation, quiet purchases over many quarters, not a single dramatic sprint. By the mid-2010s, the trend was clear: a higher gold share and a lower dependence on foreign currency assets. Then, 2022 made the lesson impossible to ignore. Large portions of Russia's foreign reserves held abroad became inaccessible. Whatever side you're on politically, the mechanics were loud. Assets in another jurisdiction are only yours, while politics allow it. From that moment on, every central bank had to ask a new question: where is our wealth physically located? Because location became policy. Gold held inside Russia didn't have that problem, and that single fact echoed through every capital city that has ever worried about leverage. If it can happen to a major power, it can happen to smaller ones. That's how a Russia story becomes a global template. From that point, the mindset shifts from defensive to systematic. Diversify, add metal, and keep more of it within domestic custody. This doesn't require conspiracy or coordination. It only requires rational self-interest. If you fear leverage, you reduce leverage. If you fear dependency, you build redundancy. Now layer in production. Russia is a major gold producer, and states can steer domestic supply toward domestic buyers. When local miners sell into local channels and local institutions hold the bars, the metal doesn't need external clearing hubs. In a world where access can be restricted, not needing the hub is the entire point. You remove choke points from the equation. That's why so many countries also invest in parallel payment channels, regional clearing, and direct settlement agreements. Here's the twist. Even if the state sells some gold to cover a budget gap, a big price move can still push total value higher. That's how you can be a net seller in tonnage, yet still post a record gain in valuation. Price can outrun liquidation, and yes, that feels like monetary alchemy, but it's simply the math of a scarce asset priced against a flexible currency. It's also why gold behaves differently than most assets. It's part commodity, part collateral, part confidence gauge. When confidence is the variable, gold tends to be the scoreboard. Now widen the lens. Russia isn't the only country thinking this way, and it's not limited to one political bloc. If you're waiting for a single announcement, you might miss the transition entirely. Reserve shifts look like paperwork until they show up as pricing power. China's reporting can be sporadic, which creates uncertainty for outside analysts. It also produces a lot of gold domestically. Some observers argue that part of that supply can be absorbed by state-linked channels before it ever hits global markets. That may or may not be the full story, but the incentive is obvious. Accumulate quietly, avoid telegraphing moves, keep options open. Strategic ambiguity is a tool. If other traders can't front-run you, your accumulation is cheaper and quieter. Silence becomes part of the policy. India has a different profile, but a similar theme. It adds gold as diversification. Less about trading, more about resilience. And when you combine multiple large economies doing some version of this, you get a steady background bid under the gold market. It's not just buying either, it's the messaging. Calling gold strategic changes how markets interpret the demand. Now let's talk about the bigger frame people keep calling BRICS. It's not a single machine, but incentives can still align. When multiple large economies want more autonomy in trade settlement, they start testing new rails, bilateral, regional, and digital. Here's the idea that keeps resurfacing. If more trade settles outside dollar-centric plumbing, then the need to hold dollars as a mandatory middle step can slowly decline at the margin. Not overnight, gradually, then visibly. That doesn't mean the dollar disappears. It means the monopoly effect weakens, and alternatives gain breathing room. In practice, de-dollarization often means multi-currency. More lanes, more options, less single-point failure. The dollar can remain large while still losing marginal share over time. In the script world, this is where you hear about commodity-linked settlement units, partly tied to gold, partly tied to member currencies. Claims include pilots for trade invoicing and settlement that reduce reliance on legacy networks and reduce exposure to choke points. You'll hear details tossed around, ratios, baskets, token mechanics, audit claims. Treat those specifics cautiously. But don't miss the bigger point. The demand is for settlement that feels harder to politicize, whether every detail is as clean as the hype suggests. The strategic purpose is easy to understand. Create an option that can't be paused by a third party, and make that option credible by tying it to something scarce. Gold is the obvious candidate because it's widely recognized, globally liquid, and it's nobody's liability. And because it's scarce, it forces discipline. Scarcity is the opposite of we can create more whenever we want. That contrast is why gold becomes attractive when debt and deficits dominate headlines. Now, I want you to notice what makes this psychologically powerful. It's not the tech, it's the promise behind the settlement unit. If the unit is anchored, even partially, to metal, it signals restraint, it signals limits. And limits are exactly what fiat systems struggle to signal. Trust is collateral. Once collateral feels shaky, people ask for harder collateral. That's not ideology, it's risk management. And that brings us to the real battlefield. Trust. Reserve systems aren't just spreadsheets, they're belief systems. They survive because enough participants believe tomorrow's rules will match today's rules. Once that belief cracks, reallocation begins. Now, let's put the key mechanics into a clean list, because this is where people get lost. Number 1, custody is power. If reserves are held in your territory, they're harder to restrict when tensions rise. Number 2, price. Repricing feels like strategy. Reserve value can surge even if tonnage doesn't, because valuation follows price. Number 3, rails create options. Even small settlement pilots signal direction, and options matter more when trust is fragile. Number 4, this is about trust. Reserve status is psychology. It lasts only while enough players believe the rules will be honored. Now, the mainstream dismissal sounds like this is just a normal accounting update. And yes, valuation math is real. But the strategic takeaway is bigger. Countries that positioned early benefit most if the measuring stick shifts again. When commentators call it nothing, they're usually looking for drama. The real story is distribution over time. Big shifts are built out of small, boring updates that accumulate into a new normal. Another detail people miss is the difference between central bank reserves and other state pools like sovereign wealth funds. A country can sell from one pocket while holding in another, or rotate assets without changing the long-term direction. And there's another layer. Central banks can diversify without announcing motives. They can call it risk management and move on. Because in public, everyone wants to look calm. In private, they want options, especially when geopolitics is unpredictable. In other words, the trend can continue even with short-term reversals. Strategy doesn't require a straight line. It requires a destination and enough patience to keep walking. Now let's address the big objections that always show up. Because if you're skeptical, you should be. Objection 1. These economies have problems, so they can't build anything credible. Response. Reserve use is relative, not perfect. Britain wasn't perfect when the pound dominated, and the US wasn't perfect when the dollar took over. Credibility is comparative. Reserve currencies win by being the least bad option at the moment, not by being flawless forever. Once a new option looks good enough, the migration begins. Objection 2. There isn't enough gold to support modern trade. Response. Gold doesn't have to back every coffee purchase. It only needs to support settlement balances and reserve confidence, and price can adjust upward when monetary demand rises. If gold is asked to carry more monetary weight, the price is the lever that makes not enough become enough in value terms. You don't need more bars, you need a higher price per bar to represent more monetary value. Objection 3. The US will just copy it. Response. Copying a structure isn't the same as matching the inputs. If the world wants more metal-linked settlement, then metal availability, audits, and credibility become constraints, not slogans. Credibility also means transparency. The more a system claims metal backing, the more it must prove custody and audits. Without proof, it's just marketing. With proof, it becomes competition. Objection 4. The Fed can defend the system with rates and liquidity. Response. Those tools manage credit, not scarcity. They can influence dollars, but they can't mint a new stockpile of metal into existence. You can't outprint a scarcity asset. Now, none of this guarantees a dramatic overnight event. History is messy, transitions are uneven, and timelines get exaggerated. But direction matters. When enough central banks diversify, when enough trade finds alternate rails, compounding becomes real. Even a small percentage shift in reserves can translate into very large flows over time. That's how slow becomes noticeable. So the key is watching rates of change, not headlines. Who's buying, who's holding, and who's settling where. Those are the quiet signals that turn into loud price moves. So what does this mean for you? Someone who doesn't sit inside a central bank. It means you should think in categories. What you own that depends entirely on trust in one system, and what you own that retains value across systems. Because if global reserve composition shifts even a little, incentives shift with it. Demand patterns change, hedging patterns change, and policy reactions change. That's how boring reserve data turns into prices everyone feels. Food, fuel, rent, and credit. And once policy reacts, it feeds back into the scoreboard. That feedback loop is how transitions accelerate. And that brings us back to that quiet update on an ignored website. One number, one line, no drama. A reminder that the most important changes don't always trend on your feed until after they've already happened. If you want the next breakdown when new data hits, hit subscribe. I'll keep translating the quiet signals before they become loud headlines.